All right, this is Mike Doyle and Tom Bennick with the mortgage firm in Wellington, Lake Worth. And we're here every Wednesday just to answer any of your mortgage related questions. We've had a lot of questions on credit. We always have a lot of questions on credit. So today we're going to do a special focus on improving your credit score. So we're going to have a special guest that comes in today too. Mark Teta has been in the industry for 30 years, and he's going to be able to answer your mortgage-related questions. We'll bring him in shortly. Tom, let me have you touch base a little on credit, and I'll go ahead and I'll bring a Mark in just a second.
Yeah, sure thing. So this is the most commonly things we get, of course, as far as people's credit, and some of the questions we'll address with Mark is, of course, how to improve, credit. Look, we all have had some kind of skeletons in our closet with previous credit issues, so Mark can go through with us how to improve those. How can I increase my credit score in a short period of time? What accounts should I take care of and pay attention to, and which ones shouldn't? Um, Another common question we get quite a bit is, I got my credit report off Credit Karma or off like my free credit reports, but why are you telling me one score and Credit Karma and another company is telling me, another consumer company is telling me something else? So Mark is also going to address the difference between the consumer credit reports that you get and, of course, the credit reports that we're going to be pulling here at the mortgage firm. The other thing, talking about that, Mark will also bring up, we've all seen the moo cow, of course, to boost your credit report. Well, Mike is also going to touch on what that actually is and what it does. So is that so-called boost worth going through, and what kind of changes that may or may not make on your credit report?
All right, Tom, we have Mark Teta here. Mark is the absolute expert on mortgage credit and all credit related questions. Mark's been in this for 30, coming up on 30 years, which is hard to believe, Mark, because I know you still look like a young kid.
I was going to say that, Mike. Thank you.
But Mark truly is. Whenever you hear people, everybody talks about experts, but Mark is recognized as the expert in this industry. And I will tell you, I want to tell you just a quick story too. Is when I first came with the mortgage for about 10 years ago, I just sort of felt like we needed to have a couple credit companies available and not just certified credit. So I would keep like one going just so we had two, and it was so much work. It was just so much work having that other company, and it was really just a good way for us to look and see different ways of doing business. I mean, Mark's group was just always, they were there, they were helpful, they were problem solvers when we had questions about credit or we wanted some insights or improvements. They were there always to answer the questions. So I gave up on that like after a year, and we've just been using Mark and Certified Credit for a while now. So Mark, give everybody just a little background on yourself, please.
Sure. And thank you, Mike. I appreciate those compliments on our service. And that's something, we absolutely strive, just like everyone at the mortgage firm. Customer service is the key, and making sure that our referral partners are getting everything they need. And so it's an excellent partnership, and we appreciate it. So Certified Credit. So we're a credit reporting agency. So we're not like a credit repair company that works directly with consumers. We do offer a lot of guidance, and we do help borrowers and consumers, but we would do that through, working with Mike or with Tom or Elizabeth, when they call in and, hey, can you pull up this credit report and give us some ideas on, maybe what we could do to raise the scores or, we deal with a lot of inaccuracies, and, the mortgage firm team that's on the call today has lots of experience. So they know some of these things, disputes that we deal with, or, junior, senior type situations. And I'm unfortunately running into that now, since my son is a junior. He's 22 and graduating college, and it seemed like a great idea to follow family traditions and name him after me and be a junior, all up until it came time for credit. So, so we're dealing with those issues. But so Certified Credit, we've been in business for close to 40 years. We service some of the top mortgage lenders in the country, like the mortgage firm. We're very fortunate with our relationships. And, we are primarily, mortgage credit. So That's really what we do. We do employment screening. We actually screen the employees for the mortgage firm and other clients that we have when they hire new folks. We have a division of tenant screening. But the crux of our business is mortgages, and that's what we're best at. And we have a phenomenal team. Most of our folks have been with us. Most of the folks came with me when I joined Certified Credit 22 years ago. I had a team of about 15 people in Central Florida, where our East Coast Operations Center is, and they came with me. So when you guys call in, Mike and Tom and Elizabeth and the other mortgage firm branches call in, you're typically dealing with folks that have been in the business for a long time. And, we take what we do very seriously. These are folks buying homes, the biggest purchase they're ever going to make. And, fortunately for them, they're dealing with the guys at the mortgage firm who are the experts in the business. So
now, Mark, what we're going to do is Mark has a presentation he uses that we'll go through as bullet points. And Tom and I will jump in with any questions, things that we run into a lot too. And we'll just sort of go through a little bit of open-ended. And also, if anybody has any comments, throw them in there and we'll toss them in. But let me go ahead and just add this in. Mark, can you see this okay?
I sure do. Yeah. Thanks, Mike.
So let's go through this a little bit.
Yeah. So, do you want me to go ahead and just jump right in and get started?
Jump right in.
Perfect. Okay, great. So, the main thing again is we're focused, our business is primarily on mortgage credit reports. So the biggest thing I want to relay to the group that's watching today is, you hear a lot about credit, you hear different places to get access to your credit reports and credit scores and all that kind of stuff. And what I really want to bring to everyone's attention is that in the mortgage industry, we use 3 specific score models from each one of the bureaus. Equifax has their Beacon 5.0. We have the Classic 04 from TransUnion and the version 2 from Experian. So just so that everyone is aware, when you apply for a mortgage, these are the score models that are used to, run your credit file and provide Mike and Tom, with these credit scores. We are the only industry that uses these specific models. So, the scores can tend to be a little bit different. And I'm sure that Mike and Tom could expand a little bit more on that. If they had a borrower that went to Credit Karma first and, hey, I've got a 790 credit score or something like that versus, when they pull the file, it could be lower, it could be higher because we're using a different score model than Credit Karma or the consumer scores are using. So those scores tend to trend a little bit differently.
Now, Mark, let me ask you, on the mortgage credit scores in general, they're just reporting once a month. Is that correct?
That is correct. And that's a great point, Mike. So with like Credit Karma and some of these other models out there, they're giving you indications that if I pay my credit card off tomorrow, this is what my score is going to be. And, they're showing you that information when in reality, the way that the credit system works is, it's the creditors are reporting your credit cards, your mortgage, your car payment, your student loans, that kind of thing. They're only reporting once a month. So really that becomes part of the differences between the consumer models and the mortgage models. They'll show things happening right away that may not be happening realistically for another 2 weeks to your file.
Right. And just to elaborate on that once a month, that there's no set date where all agencies, I would assume, need to report. Visa might be one date, American Express might be one date, Toyota. Is it a free-for-all, or is it everybody's got to report by this date what took place that previous month?
Yeah. So that's a great point, Tom. Awesome. So yes, everybody reports on different days of the month. Just imagine the credit system and the millions and millions of files that they're dealing with. So it's impossible for all mortgage companies to report on the same day every month. Your credit cards to report on the same day, your car loans. It would be too much influx of data for the systems to handle. And that's why, for everyone listening, it's so important to be working when you're getting pre-qualified on a mortgage with somebody like Tom or Mike or Elizabeth that understands how these scores work, because they may pull your file at the beginning of the month and you're 5 points shy of what you need to do. And they know that, look, if we re-pull that file again toward the second or third or even toward the last week of the month, those accounts will update, and that will change the score and potentially help us fit that program guideline that we're looking for on that score requirement.
All right. It looks like this is what you were talking about, Mark. This screen here was the Vantage. Those are the consumer online things that they're looking at that just report a little bit differently from what the mortgage models are, right?
Correct. So Vantage was something that all three bureaus came up with years ago to call their consumer score model, to try to be more consistent along their lines, because each bureau is independent of each other. And that's why, so in the mortgage space, we use the middle score because the information that's coming from Equifax, TransUnion, and Experian may be different. And by different, I mean that not every creditor reports to all three of the credit bureaus. So they're charged a fee for sending in their information to the bureaus each month. And you may run into a small collection account or a collection company that's based maybe out of Wellington or Lake Worth, Florida. And, resources financially are not, readily available. So they may only report their information to Equifax to save money and not send it to TransUnion and Experian. And so when that happens and you pull their credit report, you're getting the collection account that's reported to Equifax, but not the other two bureaus. And now all of a sudden your Equifax score is way lower than the other two bureaus because they're not picking up that derogatory information that Equifax is picking up. So, it kind of works. That's why we use the middle score. And like this graph that Mike just brought up on the screen just kind of points out some of the differences. Like, let's take, for instance, we have somebody that only has one account on their file. And we need to add another account. So opening a credit card is necessary, or doing a car loan or something like that. What's important to remember on the mortgage side, because that account only reports once a month and because it's a brand new account, it takes a period of 4 to 6 months for that brand new account to really have a positive effect on the credit score. Because what the credit score algorithm is looking for is when you're borrowing money and when you're paying money back. That's where that number comes from. So if you're sitting dormant and you don't have any credit cards that you're using every month, or you've paid everything off, like some of the programs out there, and I can't remember the gentleman's name that always comes to mind as a credit guru, more or less, that says, pay everything in cash and buy everything in cash and don't worry about having credit. Help me out with that gentleman's name. Do you guys know? What is his name?
Gordon Ramsay, or is it a?
It's Ramsay, but it's not Gordon. That's the chef.
Oh, yeah. I think Dave Ramsey. Dave Ramsey.
And you know what? And there's nothing wrong with that advice, you guys. It's awesome advice. But I don't know about you guys. I sell credit reports for a living. I don't have $500,000 in cash to not get a mortgage to buy a house. I don't have $60,000 to buy a new car in cash. So we need credit. We need good credit in order to have people lend us money. So what's really important is that new account takes a 6-month period to help on our score models, because, we're looking for, are you borrowing money and are you paying it back? We're on the consumer side. When you open a brand new account, your consumer or Vantage score or Credit Karma score may show like a big increase right off the bat, even without any history whatsoever. So that's where it's really important to understand these other reporting systems. Like if you go to annualcreditreport.com or Credit Karma, they're not wrong. They're just different score models that interpret the data differently. And typically all of the accounts are the same. So your mortgage account, your car loan account, and all that is on all of the reports, but it's interpreting the data differently. And that's where our score models look at things different. Hey, look, our score models want to determine whether or not you're in a position to spend $300,000, $400,000, $500,000 to get a loan for a house, not open a credit card or get a car or something.
I do tell my customers, because most of them do know what their online credit scores are. So if they're pulling a 760, I'm probably not pulling a 560 mortgage credit.
Right, correct.
I want them to know that it's not going to line up exactly. Their 720 could easily be a 680, and that's it's a big difference. But again, a 760 on their side is not going to generally relate to the 560 on our side. So it gets us in the
yeah. And I think it's a great resource. Hey, look, everyone should be paying attention and looking at their credit file and seeing what's going on. Just don't be that concerned with the credit score, because if you're paying your bills on time and you're managing your credit properly, you're going to have a good score. Gotcha. So,
all right, Mark. So tell us, how's your credit score made up? Where's it come from?
So this is a great pie chart here that just shows. So payment history is 35% of your score. Are you paying your bills on time? extremely crucial, especially on the mortgage side. You know, the last thing you ever want to do is be 30 or 60 days late, as Mike or Tom will tell you, on your mortgage if you're trying to refinance or get a new loan. So 30% is the amounts that you owe. How much money do you owe on your credit cards, on your mortgage, on your car loans, that kind of thing? Length of credit history is very important, you know, especially for us guys who have been around for a long time and have credit files. So the longer you have trade lines on your file, that's helping, because length of history makes up 15% of your score. Credit use is 10%, super important. Do you have revolving and installment accounts? Our score models really look at both. They want to see revolving as well as installment. So installment is you guys know this, your mortgage, your car payment, your student loan, your credit cards, or your revolving stuff. And then, you know, are you out shopping for new credit is the other 10%, because inquiries do deduct a couple of points from your score. A hard inquiry is done when you're borrowing money, and that typically deducts a couple of points from your score. So are you out shopping for credit cards or car loans or mortgages, that kind of thing?
So Mark, I get this all the time, like on a mortgage credit pull. The first hard inquiry on a mortgage credit pull is what? Do we have an idea? Are we talking 5 points, 10 points?
Yeah, I mean, yes, you're in that range, because a lot of factors go into how many other inquiries on your file when you have that inquiry. I try to tell people it's generally in the 5-point range to having your credit looked at.
Okay.
And then
go on, Tom.
I'm sorry. Then after that, let's assume that a borrower is shopping and then they had their first credit report pulled by X bank, and then they come to us and we pull their credit. We have a little bit better terms. Is there any recourse on their score at that point?
Yeah. So within the mortgage and the auto industry, you have a 30-day window to shop multiple outlets, and only the points deducted score the one time within that 30-day period. So you could have gone to a couple of other banks before they've come to you. And as long as it's all within that 30-day period and you've pulled their credit again, you know, they're not going to deduct the points for every time, as long as it's within 30 days from the first pull.
Okay, gotcha.
Now, Mark, I've got a couple questions on the screen too. So,
sure.
In history, when you have a late, does it start becoming less at like three months or 6 months? So if you have a late on a car payment, but now you have 3 months on time, or 6 months or 12 months, are there certain time frames when I can start saying to my customer, all right, you had that late, but once you're 6 months on time, we're going to start seeing a little bit better improvement? Or is it just...
That's a great point, Mike. Absolutely. Once the derogatory account has been brought current and it's moving forward, you know, each month that goes by that it becomes an older derogatory account or a derogatory reporting, it's helping. And 6 months and like 12 months and then like 2 years are kind of like trigger times for that. You know, once it hits 6 months, you'll gain back, you know, a certain percentage of the points that you lost. You know, a year helps even, and then 2 years. Older the derogatory stuff gets, the less of a negative effect it has on your file.
And also, what is the maximum percentage owed? Like if you have a credit limit of $1,000, where should my balance be? Because occasionally I'll run analyzers that will tell somebody, put $100 on this card for a 10-point score improvement. So a zero balance isn't necessarily optimal. What gives you the best score?
So, and that's a good point, Mike, because why it does that is if all of your credit cards are zero and you're not using your credit cards, putting a balance on one of your credit card accounts can help increase your score, as crazy as that sounds, because you're not utilizing that, and the algorithm can't determine a balance and a payment. So you're not getting as many points as you would if you were borrowing and paying it back. Remember, the credit score, that number is only based on you borrowing money and paying it back. If you're not doing that, you're not maximizing the potential from the score algorithm.
Now, if I put $100 on my credit card and I pay it off every month, it sees me using that credit card, right? Even Correct. If it's zero balance, but I put 100, I pay it off. Is there an advantage to putting 100 on and paying it down to 50, or putting 100, paying down to zero? They see it being used still, right?
Yeah. So this is where things get a little crazy. It's a little confusing, but you know, realistically, happens is you only have that score when your credit was pulled. Okay. So if you did a loan 2 years when you had a 760 score, all that is great. Have a 7 score, and you might have an 800 or you might have a 710, depending on what you did in those 2 years. So what's really important to remember is, for everyone on the call, if you think you're going to go get pre-qualified for a loan, you really want to have like your credit card balances be around or less than % of the
I'm
balance.
sorry, Mark, you were breaking up. Could you say that again? What percent?
Yeah, sure. What's important is if you're going to go get pre-qualified for a mortgage loan, you know, that's where you really want to have your credit card balance and in check, with maybe having your balance be 30% of the high, or maybe a little under that. People get tied up with that. Oh, I need to do that all the time. And quite honestly, you really don't need to do it at all or worry about any of it unless you're going to get your credit file pulled to be pre-qualified. So if you're not doing that, don't worry that your balance is now $800 on $1,000. But if I was going to go get my credit pulled by Mike or by Tom tomorrow or next week, make sure that the balance on my credit card was more than maybe $250 or $275 on $1,000 to keep that 30% mark, because I want that to happen when the credit file is pulled. You guys see what I'm saying on that? You want to be in a position when the credit file is being pulled to determine and create the best score possible. So if you're not having your file pulled, it doesn't, I mean, don't max your card or max it out or anything crazy like that, but you want to have it check, and maybe even call and talk to Tom or Mike first before you get pre-qualified. Hey, here's where the balances on my cards are. What do you guys think? Where should they be? And they'll direct you that they really should either be, you really only need to have 1 or 2 cards have a balance. So if you use credit cards, great that 4 of them are paid off, but you want to have a small balance on at least 1 or 2 of them to maximize that scoring potential.
The interesting thing I always find, and this is what's always also difficult, is you can have 2 people that have the exact same credit profile, exact same payment, exact identical. But one of them makes their payments the day before they report to the credit agency. So their credit cards are all paid off. The other one makes their payments the day after they report everything to the credit agencies. So their credit cards are looked to be maxed out. So they have the exact same buying, everything, life, but their credit scores could be seen when we pull them 50, 60, 80 points difference because of when they make their payments versus when they report them to the credit agencies.
Right. So the way I break that down, Mike, and everyone can do this, pull out your credit card statement when you have a couple of minutes later, and you look at the closing date. So every credit card has a 30-day cycle, an open date and a closing date. Now there's also a payment date on there. So your payment date is just when your payment is due on the credit card.
Right.
So if you pay off your credit card on the payment date, pay it down to 0. And all that's fine. That's all good. But the next day you start using your card. There's usually about a week between the payment date and the closing date. So what happens sometimes, somebody will say, hey, I paid off that credit card. Why is it showing a balance? It's because they started using the card after they paid off. In that week between the payment and the closing date, the closing date, whatever your balance on the closing date, that's what the credit card company sends to the credit bureau. So if in that week you charged up $500 after you paid it, your balance is now going to be $500 when they report to the bureau. So that's where sometimes people, I'll get, hey, I paid off credit cards. Why are there still balance? And I'll ask them, did you use the card right away after you paid it off? Oh, yeah, well, I've run my business or I had to do it that way. But you can determine, so you'll know that if you make your payment on the payment date and you want your balance to be 0 on the credit report, just don't use the credit card for the next week until after the closing date. And it will show you those dates on your credit card statement so that you can figure that out on your own, kind of deal.
That's very interesting.
Because that helps with us on our rescoring and all that kind of stuff. A lot of times, we can avoid a rescore charge or something. Hey, let's look at the credit card statement and see what's on there.
Did you want to touch on this, or what is this?
Yeah, so this is Experian Boost. So just, talking about different things that can help, your credit score situation. I bring this to your attention because this is another example of the different R score model, consumer score. Experian Boost. You've seen the guy on TV, the wrestler John Cena with the purple cowl and all that kind of stuff, and all that's great. Experian has tons of money for marketing, and that's awesome. So Experian Boost is basically taking accounts that are not traditionally reported to the credit bureaus, like a cell phone or your cable or your FPL bill or something like that. What it's doing is it's putting it to be part of the credit bureau, and it's helping your Experian consumer credit score. So Experian Boost only helps the Vantage consumer score or newer FICO models, but the Experian Boost program would be something that Mike or Tom would recommend you guys do to help your credit score on the mortgage side, because our mortgage algorithms don't take those accounts into account. They don't factor them into the score. You can help increase consumer credit score with Experian, but that in no way help increase your mortgage credit score. So just example of some differences that are out there.
Okay.
So this is our scorecard, and we talk about different things. So everyone's credit report is on multiple cards, and these are just examples. So non-bank credit cards is the first characteristic, and it's just showing you that if you had 3 credit cards, you would be getting 40 points added to your score for that category. But if you dropped a card or you added a card, you're not getting quite as many points added to your score. So this slide is just an example of a number of things: number of inquiries on your report, the number of months that the accounts have been on your file. Like somebody like Mike, Tom, or myself that, we're a little bit on the older side, if you will. And I'm not saying that we're old by any means, but we have probably a ton of accounts on our credit file. So we're probably have 4 or 5 different scorecards that develop our credit scores versus somebody like my son who just started out. He's an authorized user on one of my cards, and he has his own card. So he's only got one scorecard that they're calculating his score from. And not that that matters, but really what I'm trying to break down here is that you're constantly being added and deducted points for these different categories, depending on how many cards you have or how many inquiries you have or how many months, you've had that account on your file. So the crux of this one is don't get your credit score tattooed to your forearm like one commercial that we used to see, because probably before the ink's dry, your score is different than it was when you got it tattooed. So it's just constantly changing. As you make payments to your mortgage and your car loans, your balances go down and the payments are on time. That's all changing constantly. So your scores are very fluid and changing all the time.
Now, Mark, let me ask you this, because I refer a lot of customers in, and I'm always looking for banks. We're not tied to anybody, but as far as I know, as of now, Regions Bank has the best secure installment loans and secure line of credit. So their secure line of credit reports as a revolving debt, or you can do a secure credit card if you want. But if you have a secure installment loan and a secure line of credit reporting as revolving debt, those are 2 things. And is the installment loan doing that much to help? I mean, should I be recommending the installment loan and the revolving debt, or is revolving debt doing more for them? A lot more.
Yeah. So on our score algorithms, we like to see installment and revolving accounts. But I will tell you, and with your experience and Tom's experience, you guys know that playing around with the credit cards is the fastest way to move the scores. Right. So if the trades are there, paying off a car loan won't move your score like paying off a credit card would move your score. Right. But it's important for our algorithm to not just have credit card accounts. Our algorithm wants to see that you have installment accounts as well, because again, we're trying to come up with a number, to say, hey, this guy is good. He's got mortgages, he's got car loans. They're looking for big loans. How are you handling that payment as well?
Right.
So it's best to have both.
Okay.
We did have a question come in, if I could read it real quick. Speaking
Sure.
of credit cards, I have some paid off credit cards. Is it beneficial for my score to keep them open even if I'm not using them?
So the answer to that question would be, what other credit cards are on the file? as long as they have one or two active cards that they're using and that kind of thing, it's look, in today's world of identity theft, you want to minimize your exposure out there. So unfortunately, me and my wife went through that last year. Somebody got a hold of our identities and started trying to open up cards and everything. So my recommendation is to have 2 or 3 cards that you're using constantly. You're putting a charge for gas or groceries or something, kind of mix it up, have 2 or 3 cards with balances that you're paying off to do the cycle of borrowing and paying off. The other ones, I mean, if you have 3 or 4 old credit cards and you're not using them, it's really your preference. But I'm trying to help people with identity theft and fraud these days. So my recommendation is to close stuff down that you're not using to prevent somebody from getting access to that and creating a problem for you.
And is closing something down detrimental to somebody's score?
Usually not, especially if they're not using that account and they've got other credit cards that they're using. Now, if you have 2 credit cards and you close one, that potentially could be a drop in the score. But if you have 5 credit cards and you're using 3, closing 1 or 2 of them probably isn't going to have a negative effect on you.
Okay. What about the age of the credit card? If you're younger and most of your credit cards are 2 years old and you want to close one that might be 5 years old back from the college days that might have been a little uglier with credit, would you say maybe keep that one open a little bit longer, or is that not necessary?
I would, only because remember, length of credit of history or length of time on the file is important. So, try to keep those older ones open if you can. And if you're going to close stuff down, try to close the most recent because it's not helping with that length of time on your file.
All right. Now, this is an interesting screen, Mark. Could you explain?
Yeah. So this is another thing that, so I live in a world where my business doesn't always make sense. So that's fun. And this is one of those slides. So this shows if your score is a 680, what would happen if you maxed out a credit card or had a 30-day late payment versus if your score was a 780. So if you're a 780, first and foremost, congratulations. That's awesome. You get the best pricing in the mortgage industry and usually the best pricing on any type of loan. Don't need 800s and 840s and all that kind of stuff. So am I correct on that a 780 puts you pretty much in the golden spot?
Yes.
So what happens is what this slide is showing or illustrating is if you're a 780, it's really difficult to be there. You have to be on top of your stuff all the time. So if you do max out a card or have a 30-day late payment, you're going to lose more points than the guy who's a 680. Because to have a 680, you've probably had one of these situations on the left happen before. So really, it's just saying if your scores are really good and you have a derogatory thing, it could deduct more points than if your scores were a little bit lower. So that's really where that's coming from. So Credit Score 101, this just talks about collections and charge-offs and that kind of thing. And, what's really important is, collections or charge-offs or derogatory credit stays on your credit file for a period of 7 years. So they have to, even if you close an account, but you had a late payment last month, that late payment and that account will show on your credit file for a period of 7 years. They're always showing derogatory stuff for 7 years. So collections and charge-offs and all that kind of stuff, what happens is they stay on 7 years from the date of the initial missed payment. So not when the collection account got reported, but when you first missed a payment on your credit card that led that credit card to turn into a collection. It would fall off of there 7 years from the very first time you were ever late, not from 7 years from when it turned into a collection.
Now, Mark, let me ask you 2 things on the collections. I mean, the collection agency, they have the ability to keep selling these debts indefinitely.
Correct.
So,
Yep.
So 6.5 years later, are they able to sell that debt to somebody else? It becomes a new debt?
They are, and it will, and they do that. And collection company A sells their stuff to B before it falls off, and vice versa. So the collection industry can be a little tricky that way. So you have to really be careful and not be afraid to look at the original debt and when did it first become late, so that you could always jump onto the Bureau website and dispute something or, kind of stay on top of that. So yeah, the collection stuff gets a little ugly. And what's really, really important to remember, and I get a million questions like this, is, regarding medical collections. I'll do a class with 40 realtors, and, some other folks will come and we'll get questions. Hey, Mark, I understand medical collections are no problem. They don't affect your credit score at all. Well, that is absolutely not the case on the mortgage side. So I know that Mike and Tom, you guys have seen this over the years. A $50, $80, $100 medical collection can drop somebody's credit scores potentially, 60 or 80 points right off the bat. A $50 medical collection could drop somebody's scores, 40 or 50 points. So it's really, really important to remember. So on the consumer side, the medical collections don't really count against you that much in some cases. And that's where that confusion can come into play. And I also think, Mike and Tom too, and this is just for, looking for your input, what I think is a lot of confusing is, I've got 3 medical collections. I can't get a loan. Well, your scores might be lower, but that's not really the case on the medical collection side, is it? I mean, you can still do the loan.
Yeah, the medical collection, and you're right, you're dead on obviously on that one, is they'll bring the score down, but we don't always factor that payment in.
Okay.
So that's not going to factor so much into your payment, but it is going to bring your score down. But
yeah. I'm sorry, if you could just briefly touch on disputes, what a dispute is, and then how it affects our mortgage side.
Yeah, absolutely. So let me just close out the collections and recommending to the group that if you have a collection, the best thing to do is to call that collection company and try to negotiate or pay that off, with the caveat that they're going to remove that trade line from your credit file, period. I will pay you, but I need to have the trade line completely removed from my credit file, because what that will do will help solve the issue of, yes, we can do the mortgage loan. We're just going to do it at a higher interest rate because the collection dropped my score. If we can get the trade line off of there completely, then we can re-pull the file without the collection on there. Boom, our scores are way back up again, and we're in a much better position.
And if they disagree to remove it, do you still find it beneficial to still pay that debt off and ride it out?
Well, what I would do would be to call Tom or Mike and ask them what their opinion is on moving forward, because sometimes these collection companies don't report for a couple of years. And if you all of a sudden pay off something that was last reported in 2018, when you make a payment to these accounts, they update the date reported. The date reported is when the creditor sent their information to the bureau. So if you had a $50 collection from 2018 and you paid that off, it's great. The balance is now zero. Unfortunately, the date changed from 2018 to 2022, and the scoring algorithm interprets that could potentially be a brand new derogatory account on the file because
Gotcha.
It hadn't been reported in 4 years. Okay. And that may cause a slight drop in the score. So before anyone would do anything with collections or derogatory credit, my recommendation to the group is call Mike or Tom, have them pull their file, have them look at it and assess from an underwriting standpoint and a score standpoint, what is the best course of action for us to do moving forward.
Perfect. Okay.
So you asked about disputes, Tom, and I didn't forget. So a disputed account is basically anytime you're disputing or saying that, this account is not mine or that late date was not mine. So when you dispute an account, what happens is that takes that out of the scoring algorithm. And so it gives you a false positive on your credit score. So say I had 3 collection accounts and I disputed those 3 collection accounts with the bureaus. And my credit score before I disputed them was a 580. Well, now that I've disputed them, the credit score algorithm takes that account out of the equation because they're saying, well, this potentially is not the consumer's trade line, so we're not going to score it. So I could make my 580 with 3 collections a 700 by disputing those trade lines. So what happens is in the mortgage industry, when you're underwriting these loans through Fannie and Freddie, well, that was part of our crash problem from back when we were all in this back in 2007, 8, 9, all those fun years. They were approving loans left and right with disputes all over them and had no idea that that was an issue. So they were thinking this loan was a guy with a 700 score that had 4 collections. when in reality he had 4 collections and he was really a 580. Wonder why they defaulted on that loan, right? Yep. So now Fannie and Freddie requires us to have the disputed accounts removed before they'll move forward with the underwriting process. And again, for everyone on the group, these are things to ask Mike and Tom, because I'm giving you general information, but there may be a situation where a disputed account doesn't have to be cleared, or there may be something along those lines that I'd just assume you get from Mike or Tom or from operations at the mortgage firm moving forward on that. But that's really how disputed accounts work. They basically are giving the consumer 30 days to prove or remove that information if it's erroneous.
Perfect.
All right. Now we're coming up on time, so I wanted to pull out some of the key things, but it looks like you've just had a couple good slides left. So
okay. Yeah, absolutely. So why don't we hit on go to the next one?
Okay.
Why don't we talk a little bit, because this is super important information, and having gone through identity theft, I treat it a little different than the years prior when I used to do these talks, and I'd never been the victim of identity theft. Please protect yourselves. Everyone out there, if you're not applying for a mortgage or a car loan or a credit card, or your kids need a new lease up at school, or somebody's going to pull your credit, everyone should have their credit file frozen or locked. This prevents people who steal your identity from opening up credit card accounts. So if your file is frozen or locked and the credit card company can't pull your credit, they will not open that credit card. They'll send you a letter and say, please remove the freeze and we'll open that credit card account for you. That's what saved us. One of the other things that's really important to remember is credit monitoring. So there's a million different places. Credit monitoring basically says you'll receive an email or a text alert or something if somebody tries to access your credit file, because you are supposed to give authorization either verbally or written in some instances to have somebody pull your credit. Nobody is allowed to pull our credit reports without us giving authorization. So what's really important is there's a million different places, your banks, your credit cards, you can go direct to the bureaus to do credit monitoring. I do mine through a company that's sponsored from AAA, the car helps you out kind of thing when you get a flat or your battery is dead on the side of the road or whatever. They have a relationship with one of the bureaus. I'm avoiding saying it because I'm not pushing that company at all. I don't recommend anyone in particular. Just get some kind of credit monitoring. I use the AAA one because it's the cheapest and I'm cheap. So it works out really well for me. But what's important is to monitor all 3 bureaus. When I first signed up with that, it was a free service through just one of the bureaus, but the other 2 were not being monitored. But what's really important is like car loans and credit cards, they pre-qualify you for loans and accounts based off of one bureau usually, whereas the mortgage side, we always pull all 3. So my point is you never know who's pulling what bureau to qualify you for what account. So it's best to monitor all 3 and to either freeze or lock your credit file. The best way to do the freeze or the lock is to go directly to each bureau and set up an account, because then you can just lock it and unlock it really quick by yourself. And I think Equifax even has an app that you can jump on the app and say lock or unlock. And it's great, because the last thing you want to try to do is call the credit bureaus and talk to somebody, because customer service is at the very bottom of their list to help us. And I don't mean to be that facetious or whatever, but I've been in the business for 30 years. I've been the victim of identity theft, and they're very difficult to talk to. So if you can do it automated through the apps or directly online, boom, unfreeze. Hey, I want to talk to Mike about refinancing my loan. I'm going to unfreeze my file so that he can pull it. And then boom, as soon as he tells me that he pulled it, I can freeze it again.
So Mark, you're saying I could just go into TransUnion, Equifax, Experian directly, just sign into the account, freeze my account just like that, and be done.
Yep.
And then you can either have a credit monitoring service or not, but you should just pop in and take care of it yourself, have total control of it.
Yeah. And like I use Protect My ID through Experian, that's the name of the company or whatever, and it's great. But I get alerts and text alerts, like when balances on your credit cards go up. I mean, you guys, I can't stress to you how much our personal information is out there. I mean, for people to just access and steal. And so, I mean, if all of a sudden I get an alert from my monitoring company that my credit card bill went up $5,000, well, I know I didn't spend $5,000. So I immediately know that there's a problem and can call the credit card company and find out what's going on and address it right away, kind of thing.
So this is the contact information here, the websites, where to go to and set it up. But I do like the idea of just having control yourself. You go in, sign in, just remember your passcodes. And
yeah, because for everyone on the call, so when Mike and Tom pull somebody's credit file, if it's frozen, that bureau doesn't come back. They contact us. You know, once you unfroze your file, then we can add that bureau to the credit report for them and move on. But it's great if you have access to know that somebody's going to pull it, and you can unlock all three of them and have you pull it and then lock all three of them right away.
All right. We're going to wrap up a little bit. I mean, the key points I think that you know, obviously, again, Mark, thanks. Truly, Mark is, when I say the expert, he is truly the expert in this industry.
You're too kind.
Truly, but the key points though really is you got to pay your stuff on time. So
Yeah.
there are just no shortcuts to not paying yourself on time or paying yourself on time. Keep your credit card balances below 30% at least the month or so before we pull. But it's not a bad idea just to keep them low. Keep a revolving debt, which is the secure line of credit, or the credit cards is usually revolving debt. And I do like the installment loans, and you don't need that much. We start building people's credit. In 6 months, we can have the credit in good shape. And I will say one thing, because people get too consumed with their credit scores. Your credit score doesn't necessarily define you. And if a bad credit score is the most embarrassing thing you've had in life, you got a pretty boring life. So don't worry about it. Give us a call and call us early. A lot of people, they want to clean it up before they get to us. And like Mark said, they're paying off collections that haven't reported for 5 years. So I'm not saying don't eventually pay them whatever, but don't pay them right now as we're trying to get your score up. So let's figure out, let's optimize what you have to try and put you in the best situation possible.
And I'll just throw in there, you guys that are listening to the call, it's really important to select the right company and the right guys to do your loans. And too many mortgage companies out there, oh, just pay off all your collection accounts and then come back to me and I'll do your loan. Well, they gave you bad advice, so they're not going to be doing your loan. And that's why it's important to be with somebody like Mike or Tom or Elizabeth at the mortgage firm. These guys know this credit stuff inside and out, and there's a million pieces to the mortgage puzzle. You got to have the right person doing it for you to make sure that it's a smooth process. So I can't recommend those guys enough.
And Tom, do you have anything to add? I know Tom does a lot with first-time home buyers. He's very patient, as I always say, with working with people on credit, trying to get them in a good position.
Yeah, Mike has always been helpful with any of my buyers that need a little bit of direction with credit. He's always available on the phone. So, yeah, whether it's going through our little credit scenario to see what we need to do to get your scores up, or just doing a few little tweaks to make things a little bit better, we're here to help as well as Mike to get things done.
All right. Hey, again, Mark, thanks again.
Yeah, Mike, really appreciate it.
We really appreciate it. And
you bet, guys. My pleasure.
All right, everybody. Have a great day, and thanks for joining.
Have a great day, too.
Thanks again, guys.
Bye-bye.